So bullish sentiment peaked on July 19th, according to the AAII survey, at 51% bullish, which is it is the one-year high. We're now down to about 45%. And I think you'll see that continue to slide down a little bit as we move into Jackson Hole and on the 24th, and then we're going to get some more earnings out, and we have some other issues. But if you think about what happened in the last 24 hours, former President Trump was indicted with 18 others on RICO charges. Russia hiked rates from, I think, 8.5% to 12%, and China cut rates. So it gives you a sense of some of the chaos we're looking at in the world today. So I wanted to step back and say, what are the things that we're looking at ARS to try and figure out what's going to matter for the global economy and the U.S. economy over the next 12 months, and really what's right in front of us. So, the things we're keeping an eye on globally are obviously China and their recovery and their debt issues, which we'll touch on in a minute. The wage price spiral that is potentially developing with union contracts and other contracts renegotiated. The deficits, which we talked about last week, but they updated the numbers from the CBO. We have inflation that's been moderating, but has the potential to reverse. You have whether companies can continue to have the profits that they're showing against the headwinds that they're facing, how we deal with the labor market issues, and then the always present fragility in the commercial real estate market. So let's jump into it. So when you think about China, their ministry one of their ministers came out and said they have insufficient demand and the economy needs to be strengthened, which is clear that the second largest economy in the world is slowing. And as you can see from the chart, it's projected to slow. But I think what you've seen in the last couple of weeks is the estimates have been even brought down even further. And I think there's 5 reasons that are kind of top of mind for it, with a 6th overarching one. Obviously, there's a liquidity crisis in the property sector that continues to plague the industry. And I think investments were down 8.5% year over year in that area. You've had a sharp decline in exports for China. You have foreign direct investment declining. You have retail sales, consumption's weak. Retail sales were up 2.5% year over year, but that's following a lockdown of the pandemic. They're expecting, I believe, 4%. So not a great sign coming out of the pandemic there. You have growing problems in their trust and wealth management products that have come out. I believe that's around $3 trillion worth of products. One of the companies that's about 138 billion that was touched all the different areas of growth in the Chinese economy is now looking at some defaults there as well. So clearly China is the number 2 economy, is facing some headwinds. We've talked about this a couple of weeks ago when we did the China session with Bill and Nick, and Nick talked about the transition that China is doing on their economy from the manufacture of low-cost goods to moving up the value chain, and that transition will have some air pockets that I think we're hitting in here, and I think that's part of the challenge with China. So clearly more to be done there. I don't think this is the time to write off China's demise, but I do think you want to be very careful in thinking about some of the challenges that they're going to be seeing in this economy going forward. I think the next area is a concern is the wage price spirals. And while compensation has generally shown some decline in the private sector, it has been moving up in the public sector. But the real issue is these big wage announcements that have come in the last 12 months. You had a big increase for the rail workers. The airline workers are up 30+%. The West Coast dock workers were up 30% with a bonus they called it a hero's bonus for them. You had United and American Airlines also up with 40 and 41.5% increases. Now the UAA, the United Auto Workers, is looking for 40% wage increase over the term of the next contract. And they're citing the fact that the senior management has reaped the rewards of the last couple of years, and they haven't. And that's going to continue to put pressure on companies. And what does that do to profit margins and squeeze? And can they maintain their price increases with other challenges going on? If you go to the next area, we talked about debt and deficits, which I touched on last week, but the CBO updated their numbers, and now they're looking at their revised forecast is not $1.5 trillion deficit, but now moving to 1.74 trillion. And they're still counting the student debt relief as part of that, but if they're not going to get that debt relief, so we're looking at really more like a $2 trillion deficit coming. And what you're seeing with the government is higher spending, accounting for about 25% of the deficit, with lower revenues accounting for another 2/3 of the deficit. So real problems here, and depending on the outlook for interest rates, the net interest costs continue to rise. It becomes a bigger problem and crowds out other investments. I think the other issue that really needs to get some more attention right now is we've had positive trends in inflation on the headline side, and this is the U.S. Headline inflation numbers. And as you can see, food was up, but energy was down a lot over the last 12 months. And I suspect that we've already started to see a reversal of that. I think you're going to see higher energy prices come back in. Food has been stubborn, and you add to it wages. We could see a reversal in some of the progress we've made on inflation coming down. I think this is a big issue in other parts of the world, but it's not one that we can ignore here. And I think this is going to keep pressure on the Fed to hold rates higher for longer. And all this pushes back to what does it mean for corporate profits, which in the euro area, inflation have been a big part of the inflation, which has led to a big push for windfall profits taxes. But you also have other parts of the inflation, like labor costs, continuing to rise. And at some point, something has to give. And I think corporate profits will be one of the things that give in this area. And it's going to require greater selectivity of the companies that are going to be able to survive and thrive in this environment, and those that are going to be able to make the investments to move forward. So, that's another challenge that we're facing. And then I want to go back to what are the odds for market expectations for the Fed. We have Jackson Hole coming up soon. The topic for that is the changing structure of the global economy, which will have some pretty meaty stuff going on. But for right now, it doesn't look like the Fed's from the CME futures. The markets don't have the Fed doing anything material, maybe a 10% chance of an increase at the September meeting. But as we look to move forward to the December meeting, I'm sorry, that's the one too. If you go to the December meeting, there's an 8% chance of a decline in rates, a 30% chance of another hike between now and then, and a 2% chance of a significantly bigger hike. But if you go out 12 months, you can see a very different picture where there's a 90% chance of rates declining, basically 90 some odd percent chance of rates declining, and in some cases significantly. I think this is probably too aggressive an approach. I think the markets got it wrong for most of this year. They were expecting 3 or 4 cuts, which we don't think are going to happen. And for next year, I think they're going to be a little too aggressive in their cuts. I suspect we might not see cuts until September of next year, the third quarter of next year, unless the markets really start to turn over and the economy really goes into a deeper recession than people are calling for now, which would force the central banks to act more quickly. So in this environment, what do you do and how do you play this? And I think that's really the big challenge. I raise these as not immediate issues that you have to worry about, but these are the types of things that evolve into what the future economy is going to be. And this is what the market starts to discount. And I think that they're going to have to focus on how wages are impacting profitability, but also how the shift of the Chinese economy is going to impact when they've been a third of the global growth for some time. And I would add to it, I do think that the inflation trends, where one area where we will see a more immediate reversal is in Europe. I don't think we can count on the energy prices benefiting us the way they have for the last 12 months. I think we're going to see a reversal there with an already creep in food prices. And I think that pushes headline inflation the other way and then creates some greater strains on the system and really pushes the policymakers into tougher choices, particularly the central banks, but also the fiscal authorities on how they're going to manage this. At the same time, the geopolitics are getting a little stickier and sloppier. So I think we're going to have to really focus on the positives that are going on in the economy. And I talked about a lot of the negatives, but the tailwinds are what's driven the market up this year. It's what's driven growth in certain areas to be above expectations. I think the big challenge is China didn't reopen the way everyone thought, and the war in Russia and Ukraine continues to push on, and the offensive has not moved as quickly as people would have hoped, and our hesitance to add the weaponry, give the weaponry to Ukraine to win the war more quickly, says that we're going to drag things out a little bit longer unless there's a big change in mindset from the West. And that's going to give us more of the same challenges that we've had for some time and extend the cycle. So I think we're in a period where you will see opportunities, but you have to be much more narrowly focused on where you're going to see them. I think this, as you saw with what happened with Japan and China and Russia yesterday, the dollar strengthened and you saw rates back up. And I think that's the other big issue is how does the long end, how do the rates in the US resolve themselves? Does the long end come up? Does the short end come down? Or do they both kind of meet in the middle? And what are the forces that would drive that change? I think those are the big issues for investors to focus on as we go forward. So Mark, I'm going to stop there and open up to questions and comments because our opportunities where we see them haven't changed from our discussions recently.
So questions, comments?
Yes, Stephen, you mentioned that we will not have the benefit of the energy prices moving forward. Wouldn't the slowdown of the Chinese economy have an impact of less energy demand coming out of China, therefore less crude oil coming to China from Russia and other places, and creating a more supply of energy in the market? And
yeah, normally I think that would make sense. I think what you've seen though the last couple of years is CapEx has come in significantly for the big oil producers because of the energy transition. So you're battling the battle is the slowdown, and this is really sums up the problems in the global economy, right? You have what should make sense normally, but because of the distortions, like China not reopening the way they normally would, and then you have these flows of oil that, because the sanctions are not the normal flows, you have all these distortions. But I don't think I think because of the cuts in spending that you wouldn't see the market just absorbing it. And I believe that we're going to be looking at rising use of fossil fuels well into the next 10 years. So I don't think the offset is as much as it would need to be to make a big impact there.
Okay, thank you.
You're welcome.
Anna?
I have a question. Thank you very much for this very informative data and information, Stephen. The question is around labor market. Do you have any insights into what drives the wage increases? Whether it's offset of cost of living or retention? Yes,
it's supply. We have a mismatch of labor supply and demand. And that's going to persist for some time because most countries' immigration policies are not supportive of the needs because of the domestic politics or trumping. How do you protect your own people before you bring other people in? And I think most countries' immigration policies are too restrictive to meet the needs that they actually have. And we're trying to solve the problems with people going in. We're trying to solve it in an ideologic way and instead of a practical way. So there's easy solutions to the labor market fixes if you had the right immigration policies.
Interesting. And then an add-on question to this. So with the wage increases, the companies are still looking at potential risk of profit management, maintaining profit. So there's a potential reduction of workforce to protect the profits. Do you see this dynamic, challenging dynamic?
Yeah, every company is trying to substitute capital for labor, and have not been successful for the last couple of years in doing that. Productivity has actually declined.
Yeah.
When we see that pickup and how that manifests itself, I think is part of what people are struggling with right now. Is the hope is that AI will do that, but the question is how soon, how quickly can they fill the gap, and how quickly can companies bring AI in that's practical, that works and does solve problems, as opposed to theoretically solves problems, right? That's one of the challenges. We have to actually have real solutions, not hypothetical ones. And we're not there yet.
Yeah, being on the people side of businesses, I see a lot of conversations about AI and a lot of fear of how AI may impact the jobs and security and the future growth for individuals. So definitely creates a lot of uncertainty in people's minds, and that impacts productivity, morale, the turnover, and other things.
Yep. And that's the other thing, that the real issue with the labor unions, though, and this has come up with the United Auto Workers, is the auto execs were getting big increases and the workers were not, because of their contracts, which is always funny, because when you're in a labor contract and things go bad for the company, you can't go back and say, well, you guys got too much money versus our profits. So it gets to be skewed arguments either way. But right now, the profitability of companies got very high the last year, but was very low 2 years ago. And it's just a question of how do you balance that out? And I think that's going to be the problem with windfall profits taxes too. Like, how do you ensure, if you're the executives of a company, pay increases if you're going to then get hit with a windfall profits tax on top of that and keep in business, right?
Yeah.
So I think that's going to be the one of the challenges that we're going to see with these wage increases going through.
Yeah, awesome. Thank you.
You're welcome.
Other questions, comments?
Mark, I just want to add, I'm really not negative on the economy. These are things that we're watching, and they could break in multiple ways. So I think it's just you want to keep clear on what some of the issues are, so when they pop up, you can adjust accordingly. I think some of these are real, though. I think what China's seeing is a very different China than we're used to, and I think we got to adjust our approaches accordingly.
I got a question, Stephen.
Go ahead, Joe.
It's sort of, I don't know if it's wrap up or not, but you talked about what could go wrong or what to worry about. What do you think is the positives in the economy, such that when you think of equities as an asset class, it gives you confidence they're going to deliver a meaningful, call it a double digit, low double digit, mid double digit return over the next 5 to 10 years? I mean, what's positive that could give you confidence that's going to happen?
I think you have multiple. I think there's at least 2 different types of companies in the market today. And it's similar to the inequality we see, and I've talked about this, but the haves and have-nots are real. And you look at Alphabet, I think they had something like 19 billion of free cash flow this quarter. Apple is sitting on 169 billion of cash right now. Very different than the guys who, have been down and out for the last couple of years, are highly indebted, and don't have great growth prospects because they don't either do AI, or what worked for them the last couple of years, they can't keep their prices up. So I think it's those who can maintain prices is going to be, price elasticity is one of the big differentiators. I think balance sheets matter more now than they have since we had normal rates before we went to zero rates. And I think you're going to see the companies that can manage at a 5% interest rate level will be the ones that succeed, and the ones that can't because they either have too much debt or they don't have the growth prospects, or they're solving old problems instead of new problems, are going to be left on the side of the road. I think there are companies that can take advantage of the incentives that governments are putting out, and others that are not going to benefit from that. So it starts to get pretty defined as to where the opportunities are. And they're the themes that we talk about, whether it's in the public markets or in the private markets, that are going to attract capital. But I just think you'll be looking at people with better balance sheets to do it with. And I think that'll be one of the key drivers. And you're going to need to see real earnings.
Do you think that'll move the indices, or it's really just pockets of opportunity and real stock pickers market?
I think this could be a lot like the early 2000s, Joe, when you had kind of big moves, and then you had an adjustment process that you have to go through, that we went through after that, where there were pockets of opportunity to make money, but the overall markets didn't move. And at ARS in that time, we were very successful in moving away from the benchmarks. And I think you're going to see that where you're going to make money is moving away from the benchmarks. And now you had Fitch downgrading, or potentially downgrading more of the financial sector. That's not a great setup, for the broader markets, I don't believe. But I do think there will be better pockets of opportunity inside that are the same ones we look at in the private or public markets.
So Dave Kroom, do you want to?
Yeah. Hey, Stephen, back on oil and gas and the spirit of R&D spend. My experience from before is that when it's stagnant and lower barrels of oil, that the oil companies will go into record spending on the R&D side, which I suspect is happening, even if it's for alternative energy. But then combined with that and a lack of a R&D tax credit in the 2022 tax year, maybe it gets picked up before the deadline. But that might have some implications. At least I see it happening in the software engineering space that I'm in, cyber that I'm currently in, that it creates a lot of risk. That how much R&D do you want to put in if you're not really getting those credits back the way that you used to? So, well,
in the E&P space, they cut CapEx at least 50% over the last several years. So big cuts have happened already, and where they are putting money is the areas you said. It's how they transition to renewables or the most highly profitable existing projects. They're not looking for future growth right now. They're looking for current profitability. And I just wonder if the spend will change if the R&D tax credit is not reinstated at some point. Does that drive further reduction in R&D spend? Yeah, I think they'll spend. I think they're at a level that they're comfortable spending with for an extended period. I do think, Dave, you bring a great point, and it goes back to Joe's question. The opportunities are the people who can take advantage of the changes the government's trying to get people to make, whether it's the Inflation Reduction Act, who benefits from that. It's really about bringing manufacturing back to the U.S. and helping with the clean energy transition. But I think bringing manufacturing back will work faster. The clean energy transition will be more of a challenge for where money is going to be made in the near term. Duncan?
I was just going to ask, going back to the windfall profits tax, I mean, where do you see that hitting? I know there's been some news on the European banks. Is that specifically a European bank issue, and which countries are impacted? Or is it broader than that?
It's broader than that, and it's picking up steam. So I believe Italy's been aggressive in that area on the banking side, but the UK and other nations have been actually putting windfall profits taxes on renewable projects, which is where they're trying to get people to go to. At the same time, their input costs are up. So it's kind of a crazy setup that we're putting policies in place to that slow down the transitions we're trying to make. So I want to do more research on it, because I think the problem is, think about running a business. How do you do your future investments if you're getting windfall taxes thrown on you when you're up a lot? But a couple of years ago, when the market was crushed, nobody was crying to help the companies out at that time either. So it's really hard to do your spending plans and your CapEx and how you move forward that way. So I think if they want to have windfall profits taxes, you do them with some level of consistency, as opposed to if your profits are over a certain amount, then they'll kick in and you can plan for that. Unplanned windfall, it makes it very difficult for good investment decisions to be made and will certainly slow the transitions down that they're trying to make.
In the banks, is that,
Yeah.
have we seen that beyond Italy, and can they do that? I'm just trying to understand that a little bit better. I mean, it's, you take something like UBS, right? I mean, would they be subject to something like that being housed in Switzerland because they have operations in Europe, or how would that work?
I'm not an expert on this area. It's one I need to dig in more to, but I believe that that the Italian business of that bank would be subject to the tax of earnings in their country.
Bill, then Mike.
Sure. Yeah, to go back to China, sort of comment with an embedded question. So China exports like half a trillion dollars to us, and they also export pretty close to that to the UK plus the EU. So even though things are changing, it's still a huge amount of volume. So I wonder if kind of the deflationary pressures that are hitting China now could be a positive spillover for us, sort of Western nations, if you will, in terms of continuing to try to ease inflation, because cost of goods will be coming down from them. And that might be a little bit of a relief valve, trying to find a bit of a silver lining in all this.
Well, for the U.S., certainly with the stronger dollar and against a weaker yuan, and we are importing deflation with that. So that does help on the goods that are not subject to the other issues that are going on. So it does help in some areas. It doesn't help in the high-end critical tech areas. That's still a problem. But in basic goods and services that are traded, it is a benefit. So we will be importing deflation because of that. We're doing it against the higher interest rates anyway, but yeah, it's a benefit for now.
Mike?
The way the offset is their contribution of global growth is a third of the global growth. So that's the offset. So which is a bigger impact, the slowing down of global activity or the benefits of lower inflation? I don't have the answer for that one.
Mike Daly.
Hey, thanks, Mark. Thanks, Stephen. Switching gears off China, I just picked up on a mention of tax credits, R&D, and the Inflation Reduction Act. I wanted to alert everybody that equipment leasing as an investment opportunity got a major bump from the Inflation Reduction Act. They've allowed the tax credits that you used to get for owning a Tesla. Now they've allowed those credits to flow through to investors. So if anybody's interested in this topic, I've got some more salient info.
We are going to have a tax-related event, Mike, that it has an international focus, but you're right to point out maybe some of these basics. We should do a refresher for some of the items here domestically that we may not be aware of.
Yeah, this is brought to my attention just a few weeks ago, and this section is 45W, and you used to have to be the owner and the driver of the car to get the federal tax credit. Now, with the Inflation Reduction Act, they've allowed these credits to pass through the investor. So in addition to the usual tax benefits of equipment leasing and bonus depreciation, they've added flow-through credits and some leverage. And this is a very small offering, so it's not, going to be available to customers at Goldman or Morgan, those kind of people. It's a smaller deal. The provider is what they call an ERA, emerging registered advisor. So they're under 40 million.
Okay.
I'll put email in the chat if anybody wants to reach out.
I think that means exempt registered advisor.
Yeah, they're emerging, so they haven't, oh, exempt? Okay. Emerging exempt, I'm not sure. You're probably right, Joe.
If you're talking about the SEC registration, yeah, it's exempt.
ERA, yeah. Because they're small and they're new, right?
Well, in venture funds particularly, yeah, there's certain exempt managers in the VC industry is one of them. They got a special carve out. So they just have to file a Form ADV, Form A, I think. I'm going through it right now. So
Yeah, less rigorous, less expensive than the full-on RIA.
it's virtually a non-event. So
Yeah.
Any other comments or questions? It reminded me, looking at you, Joe, the Queen City Angels reported on a tour, or it was a meeting of the American Venture Capital Association, lobbying for the continuation of that tax treatment for the small business, one of your favorite
1202.
programs, yeah.
Yeah.
And I believe, and that's the question, is Jack still with us? That the meeting of the American Venture Capital Association will be in Columbus, Ohio, May next year. May 13th and 15th. We might have to coincide our event to be before or after that.
Mark, that's correct, and that's a good idea.
Thank you, Jack. And Jack, we want to hold a Cincinnati roundtable on the 10th after the morning after the Queen City Angels meeting, or the morning of the 9th. Looks like it could fit either way. So I just want to coordinate with you. And I know it has to deal with post-season performance of the teams that you partly own, but we should coordinate.
Well,
nonetheless.
Can you make sure that Miami's playing that weekend there, that time there?
Well, Miami's playing the 23rd of August, which is a week from tomorrow. And the city is already holding its breath for the arrival of Messi.
Right.
And you've gotten a couple requests for tickets, Jack?
It's I've been a little startled by the number of friends that I apparently have, and because it's a larger number than I ever knew.
Oh, you're the prettiest girl
Hey.
to pull all of a sudden.
Now, Paul, in all seriousness, Paul Mann-Jones just come on, and Paul, you've been part of a discussion with you, me, and Stephen. Can I put you on the spot? We're trying to see what the impact is of some of the programs that have been putting money into the economy, plus the student loan combined with
Yep.
and you've been studying this. Do you want to make maybe a comment? Question?
Sure. Yeah, I think what I've been looking at is, I guess, two things. The employee retention credit that I guess has gotten a lot of focus. It's endless commercials on TV about it now. So that when I was checking, I'm trying to actually find the real data behind it, but I was told that it's on an annualized basis, which is, I think maybe he was using a 2 or 3 month average, like effectively $400 billion added to GDP. So we potentially have an inflated GDP number for that. And then number 2 is the effective amount of $300 a month for 40 million people coming out of the economy, possibly. So that's $144 billion starting, not that everyone's going to be paying, but let's say that's what's due starting in October. So, that's another kind of $144 billion that GDP maybe is, over for that, that adjustment to come out. and I wasn't on the first half hour, so I have no idea what you guys talked about. So you know, those are the kind of things I'm trying to do, get detail on, and really see like, what does this mean for, you know, the economic growth of the country. And then I guess the other pieces are, you see all this infrastructure spending and how that really comes into effect. I guess one of the issues was the construction of I'm trying to think of the TSMC factory. So that's the, you know, the chip factory in Arizona. And the company had to ask for an emergency 500 visas for Taiwanese employees to come to the US because, and I was a former chip designer. I taught a VLSI course at MIT. Like, I know a lot about the business, and, you know, that, so we don't have the people to do the work, and it's really hard work, and you have to be, it's like you need a PhD or a MS to do this work, which is actually very hands-on. Like photolithography is, you know, it's, you know, we're talking, it's 8, I think we're down to like 6 nanometers now. When I was doing it, it was 600 nanometers.
They're working on 2 now, Mark.
Yeah.
They're down to 2 they're working on.
Yep. And so that's the, you know, the level of detail you got to get to. And so how does all this, can we really, like, how is this going to affect the US if we don't even have the employees here? And the last piece specifically about the chip business is that the chip business is highly cyclical, meaning, and they used to print this thing called the book to bill ratio, which they don't print anymore, which is, you know, it's like feast or famine. It's like we're building all this capacity for a need that, you know, for chips and autos that happened, 18 months ago. So we're building all this supply that may not be a need. And I see Joe kind of nodding his head. It's like that's one thing that you always saw, like, you know, Intel almost went out of business for this, like, you know, 35 years ago or something like that. They were,
so did Apple,
in the DRAM business, and they're not in the DRAM business anymore. But you have this highly cyclical commodity business when it comes down to it. And now we're building it, all this infrastructure. It's great that we have it, and it's good for like chips we need for F-22s, but it may not be good for chips that we need in, you know, PCs. So that's, you know, that's why it's not in the US. Right? Because when I was starting, I remember I was at Maxim Integrated Circuits. I was helping them on something, and then we were working on stuff, and then we walked to another room, and there was literally like 100 women, like doing wire, you know, building boards, and right there in the designs, you know, area where they so there's things around packaging, there's things around the wafers. So yeah, just to end, it's just like, this is a highly cyclical business, and now we're building, like, the reason why we got this all out of the US is because we didn't want to have the investment, and now we're putting the investment in. Well, you know, you're gonna feel the reaction of the business cycle in the chips business, you know, and then multiply that by X times, because I'm trying to think of the other article was that the Biden administration has this, they called it the $400 billion man. This was I forgot the gentleman's name. He's helping with all the green initiatives and the investment in the green initiatives. This was in the Journal maybe 3 or 4 weeks ago. And it just, like, maybe the business side, you know, the economy should decide where the capital goes, not like a smart group of people. You know, it's better like the hundreds and thousands of individual decisions that, you know, have a better sense of where capital should go versus, you know, a committee. Committees usually don't do a good job in selling where capital needs to go when you know, technically they're.
Hey, Paul, what else is bothering you?
Keep it up.
That's about it.
You sure?
There's a lot of other
I was
stuff,
interesting today.
You're on a roll there, so I just wanted to.
Well, I think it's you know, I think those are the things that we think are additive to GDP. And we just got to figure out, like, is it really going to be additive given all those other, you know, and, you know, I don't have all the backup behind all this to say, like, you know, but
Well,
you
here's
know,
what-
these are the
one-
topics I've been thinking about.
One thing okay, infrastructure side, we have not invested in deep tech for a long time, and there's a lot of deep tech investing happening right now. And I don't know if it's being channeled by the $400 billion man. But I know it's coming into VC portfolio companies that are managed by these VC funds. And I'm encouraged that deep tech is finally in vogue. It may not be optimized, but there's got to be some uptick finally. But you're more nuanced on.
If I could take a stab at this, because Paul,
Yeah.
you raised some really important points, and it goes back to what Stephen said, that, you know, the government has just done an atrocious job with interest rates and all the money they've been the helicopter money at trying to stimulate sort of income statements and income statement behavior, consumption, if you will. At the same time as, yes, they're now doing a massive industrial policy or to rebuild our balance sheet assets as a country. And I would argue that yes, industrial policy done by a committee in Washington is absolutely absurd, and it's going to become a political boondoggle and giveaway to their buddies. We know that. That's just the nature of the beast. But it's a less bad spend than trying to just push money into consumers' hands to get them to go buy shit they probably don't need, just to keep an artificially inflated GDP, to your point. They've been inflating the GDP numbers and their earnings numbers and the stock markets and asset values for a decade.
Yep.
Largely through the monetary policy and trying to focus on the income statement metrics, but even that's getting exhausted. And so now they are switching, and I think it's a less bad government policy. Spend government dollars on balance sheet assets.
I would just add that the chip industry today is very different than it was 10 years ago. It has gone through a massive consolidation. They have lived previously in boom and bust cycles that were consistent with what you saw in other cyclical industries like the energy sector. And I think similar to the energy sector, they've rationalized their spends very differently than they have in the past. And it's become much more defined market as to who's playing in what spaces. So I think it's a very different industry today. It's much more rational. So I think the fears of overbuilding in the chip space are probably a little overdone. You also have to keep in mind that you need to, from a national security perspective, be thinking about the chips industry from, we need the West and our adversaries need half of what they were producing before, because we're only going to be serving probably half the world, depending on how we fragment the global economy. But you need redundancies, and they didn't have the redundancies for national security reasons. So that's a big element as to what's going on in that space. But I also think for years, people have been saying that this industry is going to go back to their old habits, and they really haven't, of overbuild when you have the boom and live with the bust after. I think they've started to break that cycle somewhat. So I think that is different. It's not necessarily that they're going to keep to it and stick to it, but their plans right now are much more disciplined than they've been in the past.